Here's Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton. Every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, could Canada see China as its #1 trading partner? The country most like our own, Canada breathes a sigh of relief as trade with Donald Trump's America is sorted and now looks out to our region. Peter Hall, Chief Economist with Export Development Canada, is in town. S&P Global Ratings economist Paul Gruenwald is also in town after the IMF conference in Bali. What does he make of the ongoing trade tensions and a rebalancing in China, the risks and how to manage them? Coming up. And our special interview with the great David Buik, direct from London, his unique take on markets, Brexit and problems in Europe. First of all, let's talk about property here. Let's actually talk about negative gearing, because above all things, this is the policy that will be the differentiator in the next election. Labour want to abolish negative gearing on all but new homes, although they'll grandfather existing arrangements. For that, they believe they will raise billions to spend on their own wish list. The government, on the other hand, warns that the sky will fall in on the property market, and they are planning a great big scare campaign, aren't they, which is already gathering some momentum. Back in 1985, the Hawke Labour government, with Paul Keating as Treasurer, effectively abolished negative gearing, or within a couple of years, in 1987, that policy had been unwound after strong lobbying from the property industry and a rise in rents, apparently, in Sydney and Melbourne. And there the position has stayed, despite calls for reform of negative gearings to be brought on, including, I think, in the Henry Tax Review. Then today, yet another report on the impact of abolishing negative gearing, this time from the Master Builders Association. Their research, modelled by Cadence Economics, concludes that Labour's proposal would be bad news for the sector and bad news for the economy. Up to 42,000 fewer new dwellings, 32,000 full-time jobs lost across the country, and an $11.8 billion hit to building activity. Now, that's the downside scenario, although it's being banded around today as if it were the most likely one, I think. Now, at one level, you'd expect this sort of a report from the Master Builders Association. After all, they are in property. And it's been leapt on by the government today. But Labour's Chris Byrne has cried foul, and in particular, that it didn't factor in Labour's policy, particularly the grandfathering side.
Given the modelling that he referred to does not model Labour's reforms to negative gearing and does not recognise that Labour's policy grandfathers existing investments, and given the government's own Treasury modelling shows a modest impact from Labour's policy of negative gearing reform, will the Treasurer now apologise for misleading the House and misleading the Australian people?
Mr Speaker, because this is what the Master Builders Association CEO said. We didn't need to consider the grandfathering because we're looking at future investment. So the hits in terms of increased housing means that future investment is less likely, and therefore we will see a downturn in the housing sector as a result of Labor's policy, Mr Speaker.
Now, the current Treasurer is right. It's true that this latest report is about the future, but given that Labor is grandfathering things, it is unlikely to hurt the key holders of properties today, you'd think, the voters in this coming election, in the sort of way that's being warned about. Labour believes it will help others, though, those who are trying to get onto the property ladder who've so far not been able to do so. Labour will also still allow negative gearing on new homes, and some companies, I think Stockland for one, sees the changes leading to a spurt of growth for them should that happen. If you work in business journalism like me, you'll have been involved in any number of property arguments about the impact of negative gearing. You can have 4 experts on a panel and there'll be at least 7 points of view. Some research points to the fact that negative gearing benefits those owning over, say, $100,000 a year, and it's once again a story of the better off becoming better off. For others, it's been one way for aspirational voters, and there's a lot of them, and they vote, to actually get ahead. If you've never invested in a second property, then this is not for you. If, however, you live in Wentworth and maybe have 2 or 3 investment properties, or 8, then you won't like Labour's plans. No surprise that independent Karen Phelps, while left-leaning on many things, has no time for changes to negative gearing. Of course, the government is going to focus on house prices, the price of your homes and investments, and what a change to negative gearing will do to those prices. prices. Making life even trickier for Labor, though, is the housing market itself, which is softening quite a lot. So prices are coming off. Would you risk a new policy that might crush prices even further? It's perfect for a scare campaign. Well, let's hear a bit more about how this story played out in Canberra. Sky News reporter Annalise Nielsen joins me live from Canberra. Annalise, yes, just tell us how it played out between Labor and the government.
Well, Labor really was firing up. As we saw in question time, you showed they really are saying that this is a scare campaign being run by the Liberal side. And I think it is interesting because there is the general consensus among many people on both sides of politics that no sudden move in this area would be welcome. But there certainly is talk from those in the middle about whether there would be some kind of benefit of just limiting that negative gearing. We've heard from a lot of people, in particular those critical crossbenchers, that maybe it should be something more like just a limit of 1 or 2 homes that you're allowed to negative gear, because the scare campaign does include that story that people are negative gearing 8 or 10 houses. And whether that's true or not, it is certainly a story that is important among the general public. People are finding it difficult to afford houses and get into their first homes in particular. And we know that millennial vote is going to be critical at the next election. And
do you think that that would be much easier to sell if you said, oh, well, no, people who want 3, 4 and 5 investment homes, we'll get rid of that loophole, but somebody who wants a second one, maybe to get ahead, OK, we'll keep that. That might fly much better during the campaign.
Oh, absolutely. It is hard to have a sympathy for someone who's got a slew of investment properties, but I think a lot of the conversation around negative gearing has been focused at those higher end earners, but it was coming out in the Wentworth by-election that the majority of people who are negative gearing do have a lower income. Many of them are around $80,000 a year, and negative gearing is an important part of setting them up for the kind of retirement they want. And so there is some support from a lot of sides as well about not touching negative gearing. We saw Dr. Karen Phelps sidestepped the whole issue, just saying that she wouldn't support any sudden changes, but said housing affordability is an important issue. And so this is something that's likely to be meted out a bit more closer to an election time when it's going to have that maximum political traction. But for the meantime, this certainly is, like you said, running the flag up the pole that this is something that people need to be concerned about.
Right, now, Annalise, Michaelia Cash, former Minister, IR Minister, she got a bit of a grilling today. Tell us, put some context behind that for us, and how did she go today?
Well, she certainly wasn't giving much away, but she did get a grilling in the estimates hearing. She was fronting up to Labor Senator Doug Cameron, who's known to be a tough cookie himself, and they were sparring over this investigation into the raid on the AWU. Now, the AWU has taken the Registered Organisations Commission to court over the raid, saying that her office tipped off journalists when the raid happened because they wanted maximum political impact. Her chief of staff has since left, and there has been this ongoing investigation. We heard on Monday that that's now been referred to the Commonwealth Director of Public Prosecutions. That's exactly why Michaelia Cash was refusing to answer most questions, but she could certainly hold her own in there. It got quite tense at times, if you take a look.
Why did you instruct them to fight the AWU subpoena if you've got nothing to hide?
Senator Cameron, again,
the AWU's got nothing to hide.
Why did they produce the documents? One may also ask that if the documents
so maybe,
are there
maybe
that show the authorisation of the $100,000 to get
my question
and the $25,000 to Mr Shorten's campaign. That is a very good point to make, Senator Patterson.
So why just address my question if you don't mind?
And I said, Senator Cameron, I'm not going to provide a running commentary on legal proceedings.
She was also grilled about where exactly her former Chief of Staff Ben Davis is. Now, he's since left her office, and AWU investigators are trying to find him so they can get more information for their court case. Doug Cameron was questioning why they haven't been able to find them and wanted Michaelia Cash to give more information about exactly where he is. I guess the answer is he hasn't been subpoenaed, so he probably doesn't have to speak to their investigators, and that's exactly why he's avoiding them at all costs. But they were pushing this as an angle, saying that they thought it showed that she was wasn't being upfront and honest with them about this whole court case. It's all the documents that were raided collected in that raid have been kept under lock and key since. No one's seen them, and so this really has been a year-long standoff between all the parties involved. Something's going to have to give at some point, but it certainly wasn't today.
And personally, I guess there's no love lost between Michaelia Cash and Doug Cameron, is there really?
No, I don't think they'll be on each other's Christmas cards list, and not just because of today, I think.
No, it's
just,
a bit of history there.
Yeah.
All right, Annalise Ilson, great to talk. Thanks so much. All right, well, let's go global now. Global trade, and S&P Global Ratings argues that underneath the choppy US trading markets is actually quite a calm US economy, despite the trade tensions starting to weigh on conditions in some reason. Recently, Global Ratings house sees strength in the US industrial sector and even benefits ahead for Western exporters. Meanwhile, in China, trade friction is set to put the brakes on technological advancement and add pressure to already growing Chinese growth, Chinese growth. We've seen a bit of that in the last week or so's numbers. We've also just had the IMF paint a rather gloomy picture of the global economic outlook. Is Christine Lagarde right, or are things not as bad as they seem? Well, here to weigh in is S&P Global Ratings Chief Economist Paul Gruenwald. Paul, great to have you back again.
Great to be back.
Now, you've just come from pretty much from Bali, from the IMF. Is it right? I mean, other people have told me it was pretty gloomy in terms of the sort of conversations that were being had.
It was gloomy in the sense that we know we're at the top of the growth cycle and growth's going to be slowing from here, and also the risks have moved to the downside. Most people are worried about US-China trade tensions and the Fed continuing to move to a more normal stance. So I think we know directionally where we're going. We can have a debate about how quickly we get there and how bad it might be, but it's a pretty easy call for now that we're going to be slowing and a bit choppy over the next, let's say, 4 to 6 quarters.
So if the Fed moves to a more normal stance, it's able to do that when growth is slowing without sort of dampening down the economy?
Well, the point is they want to get growth down to a stable non-inflationary level, which is 2-ish in the US, and they want to try to maintain full employment. And in their view, to do that, they've got to go through 3, maybe 3.25, 3.5. And then the good outcome is to put the US economy on a glide path, maybe a bit less than 2 in growth, a bit less than 2 in inflation, and that's what they're targeting to do. Where we are now is not sustainable. 4.2% growth for the US is not sustainable.
Okay. Meanwhile, in Europe, we're seeing slower growth than was expected, aren't we? Is that
yeah, Europe's been, well, Europe's mature, and we tend to think about it as rather high and flat, so it's never been the dynamo of the global economy in the recent past. So really most of the action is the US and China, but most of Europe seems okay. Germany seems to be doing okay, leading export economy there, so no real concerns about
How do you see geopolitical risks there? I mean, we've got Italy, of course, we've got Brexit.
Yeah, well, things aren't looking too great for Brexit, right? I think the probability of a hard Brexit is rising in our view. Italy seems a little bit more positive. Our reading of that is the European Centre in Brussels wants to reward Italy in a sense for staying in and try to reach a negotiated settlement about the budget deficit. So relative to the UK, right? The UK wants to leave. They say, okay, leave. Try to make life a little bit easier for Italy, but that's going to be a long process as well.
Okay, all right. Let's get back to the big game in town, which is trade between the US and China. This has been ratcheting up. Where do you see it going?
We've got one more tariff move from the US. The US has judiciously not put tariffs on Chinese exports of toys and electronics because of the Christmas season and the election. So we think that one's next. We really think this is not about trade in the end. So we would expect the discussion to move or pivot away from trade toward essentially how China does business. Intellectual property, bilateral investment, playing by the rules.
This was originally what it was all about. It was all about
right, so
tech,
trade's
IP.
important. There's some optics around trade. It's a politically charged issue, but really the big discussion is probably going to be around these other issues. We're watching the G20 when Trump and Xi Jinping are supposed to meet in Argentina next month, and maybe we can get some more clarity around where we're going next year.
Right. So you actually see the trade war at the moment not biting down significantly at this stage in either America or in China?
In the US, it's hard to see anything at all. China was feeling some pain from deleveraging, and then on top of that, the trade war started. So the recent moves by the Chinese government, lowering the reserve requirement and dialing up the infrastructure, that's to keep growth near their target. But I would say that some of the commentary around China taking a big hit is a bit overblown right now. There's been a moderate slowdown in growth, but it's still 6.5 in our view.
Yeah. How do you think the rebalancing has gone within China? You know,
it's going very well. We just wrote a piece on this where we're arguing Chinese consumers are driving global growth, and the big beneficiaries of that are actually, surprisingly, the EU and the US. If we look at their exports to China and what percentage of that is in the consumer goods sector, both of those are rising. So when we get China and the US to the table, the US wants long-term access to the Chinese middle class, and China wants access to US technology to fulfill 2025.
Do you really see these Chinese consumers actually, becoming a major force?
They are a major force. Yeah. They're already driving Chinese growth. China's driving global growth. So we're used to talking about the US consumer driving global growth. I think that's increasingly going to be a Chinese consumer story. You can see the types of exports they're pulling in, even here in Australia, right? You've got strong exports in commodities, but rising exports in consumers, travel, tourism, professional services, etc.
So I come back to, I mean, you paint really a relatively rosy picture. Why was IMF so gloomy?
No, I'm optimistic about that last story. We're actually a bit worried about the trade war bogging down to a big discussion about the US and China around the Chinese economic model. The tariffs would stay in place for some time in that scenario. Yeah. Then as that drags on, how does that feed into capital expenditure? How does that feed into consumer spending? What happens to the small and medium countries that are in all these production supply chains? So that's a bit of a downside risk that's really a second round.
And do you have a view on the risk in, again, I was asking when these trade tariffs actually bite on either side as to who blinks first. Now, clearly you've got the midterms in the US. Right. It's not going to impact, doesn't look like it's going to impact until after that, but will it impact before another election? Well,
I don't think either side is going to put up the white flag and surrender, right? We need to find a politically feasible way to get both sides to the table, have the big discussion. This happened before. 10 years ago, we had this strategic economic dialogue between the Bush-Chu administration and China. So in this scenario, we get someone from the US side, someone from the Chinese side, Liu He, who's in charge of economic policy, sit down and have a big discussion. How do we get along?
It's when pain happens on one or other side.
Right. You're going to have. Well, that's the thinking. But the other thinking is that we just head it off and sit down. And if we're waiting for the pain, we may have to wait a bit longer because so far, as I said, it's pretty marginal so far.
So great hopes for the South American meeting.
We're looking at Argentina to see how the G20 shakes out between Xi and Trump.
All right. Paul Gruenwald, great to get your views. Thanks so much. And after the break, we get more on the latest in Australian politics, including support from the government on a $1 billion top-up for the Emissions Reduction Fund. More on that next.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, let's stay in the trade space for a moment or two. When Donald Trump arrived at the White House, the nation that got the biggest shock was Canada, with the idea that the new commander-in-chief might blow up NAFTA, the hugely successful trade deal between the US and Canada and Mexico. So there was a collective sigh of relief in business, investment, free trade circles when NAFTA 2.0 was finally agreed, even if it did end up having to be called the USMCA. Well, it couldn't be NAFTA after all for Donald Trump, could it? So, with the new deal in place, Canada is now looking west for new trade deals, even with a potentially bigger trading partner, China. Well, Peter Hall is certainly an enthusiast, the Chief Economist of Export Development. Canada is out in Sydney this week for the 2018 Australian Economics and Finance Forum, hosted by the Asia-Pacific Loan Market Association. I caught up with him this afternoon to discuss the state of international trade and the challenges that the countries like Australia and Canada have. Peter Hall, it's great to have a Canadian in here, and, you know, the Export Development Council we haven't actually spoken to before. So
it's great to be here, Ticky.
All right. Now, the big thing that obviously has happened for Canada is NAFTA Mark II, or this USMCA. How has that changed how people look at Canada at the moment?
Well, I think there would have been a radical change in the way people look at Canada had we not had a deal.
Okay.
NAFTA defined our relationship with the United States, and without that, our #1 trading relationship would have been at tremendous risk. So the sentiment in Canada at the moment is one of great relief. This was risk #1 for exporters. Now that's over, we're sort of able to get on with our lives.
So somebody I read about put it that Donald Trump's very good at shaking the snow globe. But now that it's all settled, has his art of the deal, the renegotiation, put Canada in a less good position than under NAFTA? Does that matter to you?
No, I think actually on balance it's better because the other deal that they tore up, the TPP deal,
yes,
actually gave some technology for upgrading this deal. So it's modernized, it's upgraded, it's updated. It has things in there that NAFTA couldn't possibly cover because those industries didn't really exist at the time. And so this is a great positive for the deal itself. If Canada has been harmed anywhere, it's really probably in the dairy sector. We have supply management there. More market share has actually been given to the U.S. in the dairy sector, but it hasn't undone supply management, and that was a real fear inside of the dairy sector.
How does it work now with Canada's trade relations with other big players around the world, for example, China? I understand that as part of the US MCA, that America has veto rights over your ability to trade with some parties in certain situations?
So this is the delicate section 32.1,
okay,
which does say that for a non-market-based economy, we have to all talk to each other before we do that kind of deal.
Is that going to cramp your style, do you think?
Well, you know, there's some people that are worried about loss of sovereignty. You know, we're just not as free to do that kind of interaction with another country, particularly China. That's really what's in the crosshairs of this particular section. And of course, Canada has identified both India and China as key target markets.
But you're not like Australia. I mean, China for us is our largest trading partner. I mean, obviously your largest trading partner is the United States and will remain so.
That might change.
That might change.
That might change. When we look at the key trading partners that Australia had back in the mid-1980s, they had the same, there was the same difference between China and that group of trading partners, all OECD nations, as there is between ourselves and the United States on a relative basis. And what has happened in the intervening period with Australia is that the exponential growth of China has now eclipsed that trading bloc. Well, that trading bloc with us is one nation. And we are on the same path in terms of the relative growth between Chinese exports, which is roughly 12% a year, and the rather paltry growth that we've had since 2000 with the United States.
So you're pretty excited about the opportunity there. The difference, of course, is there's an ocean between you and China, whereas we feel very much that we're in the region.
Well, if you look at shipping distances between Vancouver and Shanghai, they're not much different between Sydney and Shanghai. So the distance, it's more a hemispheric kind of thing. You know, it's similar time zones, and that's a bit of an advantage for Australia. But in terms of shipping distances,
equally, the US is on your border.
Yes, oh, absolutely, definitely. I mean, close, a homogeneous market. There's very little difference between Canada and the United States. So it's a default zone for Canadian exporters. But this has shaken the ship up a bit, you know, taking that relationship, you know, almost a sacred relationship, and shaking it up as much as it was. You know, diversification has become a word in the vernacular of just about every Canadian exporter. Not only that, but the recent cabinet shuffle that we had our Minister of International Trade changed to the Minister of International Trade Diversification. That's a very solid and definite policy move that has been made by our government.
Now, the other thing that's changed, I suppose, in recent times is Donald Trump's tax policy in the US, because previously the Canadians would have been looking very good, wouldn't they? What's your tax rate, company tax rate?
Well, our company tax rate, corporate stated, is about 25%.
Yeah, so now with Donald bringing the US rate down to, what, 21%, plus he's got the depreciation thing happening as well. Has that affected investment into Canada?
Well, that's another issue that Canadian exporters are talking to me about, because They are considering business on either side of the border. It's a very fluid border when it comes to investment.
Yeah.
And of course, we as an organization are quite okay with that, with businesses making a decision on where it's best for them to be. We're quite open about that.
The Canadian government looking at bringing taxes down even more to compete?
Well, not so much the taxes, maybe the accelerated depreciation. And I'm only speculating based on what I've heard in newspapers in Canada, but there have been talks. There was a significant Senate paper that was written on this issue. They did a consultation. They tried to enumerate what the cost was for Canada. And so the ante is now up. The pressure is on our finance minister to actually make some kind of decision about that.
So if we're now looking at Canada's interest in Australia, which I always find fascinating, the huge amount of Canadian pension fund money and other Canadian investors that have come here, particularly in things like infrastructure, are we going to see more of that? How much is there now?
I don't actually know the number. I haven't added it up
It's
myself,
a lot, I think,
but it is a lot. It's quite substantial. This is our largest foreign investment zone in all of Asia. By quite a margin. So that's a significant statement. I think what Canada sees is another relatively homogeneous market with a very similar history and established ties with regional trade. So the amount of trade that Australia is doing with China is staggering, and the growth of that in a very short period of time. In 2000, it was 5% of overall trade. It's now over 30%.
So
that's remarkable.
Looking again at you know, where Australia now sits in terms of its competitiveness as an investment destination, you're looking at the Trump tax cuts. We haven't moved on company tax cuts. Our power is now becoming a major issue, the cost of power in Australia, notwithstanding our resources. Is that impacting, do you think, Canadian money coming into Australia at the moment?
You know, I don't know the answer to that question because I haven't posed it to the companies. But what I will say is that Canada and Australia are very similarly situated in terms of our economic mix. In my judgment, Canada definitely has a bit of a bubble going on the domestic side of the economy. We have very high indebtedness ratios, and Australia can relate to that. Yours are even higher than ours on the personal side of things.
But what about your power costs? Because, I mean, you've got, well, you've just got Shell, who's opening up and developing LNG. That's going to be a massive deal. Are your power costs for manufacturing in Canada a lot cheaper than ours?
You want to look at the manufacturing heartland in Ontario, and we have a power cost situation that's going on there right now. A very big move to shift into clean tech, and some of the encouragement moves for that have increased our average costs as well. So we know what it's like to pay higher costs for power, but when you look at the synergies between the economies, I really think that that's what makes the difference. The investment flows really have a lot to do with the similar kinds of things that Canada has to do, the comparative advantages that we both share in that. And I'd like to believe that these investments are moved towards creating some sort of capacity or a scale effect in the combining of our two economies. I mean, together we've got a population over 60 million. And that puts us...
It's almost like you're sounding like you're interested in some sort of Commonwealth trade deal.
Well, you know, maybe a dual one anyway.
It's a bilateral.
Sure. I mean, this is a scale economy. When we talk about globalization, when we talk about taking on very large economies with 1.1 or 1.3 billion customers inside of them that are growing at a phenomenal rate, it's very difficult to keep up with that, with the kind of scale that we have in industries other than sort of mining, oil and gas, and the agriculture sector. And so building that together is, I think,
finally, can I ask you quickly about, I mean, you have quite a bullish view, I think, on global growth.
Absolutely.
How does Canada feel about Brexit and opportunities there?
Well, the last thing I would ever counsel anybody to do as an economic forecaster is to forecast by flipping a coin. But if you look at the way that the Brexit vote went, there were so many 50-50s inside of that. It was London versus the rest of England. It was all of England versus the rest of the kingdom. Scotland sort of teetered in favour, but it was about a 50-50 thing. The same was true for Ireland, true for Wales.
Does Canada see any upside in it?
Well, I mean, there's even a 50-50 split inside of the party itself. So it's really unclear as to how this thing is going to go forward. I mean, it's a mess, and it's compromising a free trade zone. The young are now out in the streets in London saying, you know, this is something that that we need to be heard on. We would like to be in the EU. It makes a lot of sense. I'm not going to get involved in UK politics, but you know, they simply hadn't an infrastructure for building trade ties.
But you don't see any big upside for Canada in any of this?
Well, you know, the UK is our third largest customer, but it's 3.5% of our trade, roughly the same as it is for Australia. So there's big movement that would have to occur to change that. I mean, the US is our big customer. There are 4 countries that are the big customers for Australia. China is really the big one. And so that's where our spheres have gone to. China is becoming bigger and bigger for Canada. It's our number 2. And so I think over time we've made shifts away from the traditional customers that we had before, and that's where we're going in the future.
Peter Hall, great to talk to you. Thank you so much.
My pleasure, Ticky.
After the break, we will talk EU. EU talks have stalled over disagreement on the so-called Northern Irish border as we've been following it. We'll get more on that with David Buik next.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, I'm pretty excited about our next guest, but just for a little bit of background on Britain. Just over 5 months until Britain is set to exit the EU, talks have stalled again over the disagreement on the so-called Northern Irish border. Now, as British Prime Minister Theresa May sets up for a second showdown with lawmakers in 3 days, she continues to remain confident in her plan for the divorce.
Can I also say to him that it is precisely the suggestion from the European Union that kept in a customs union, while the rest of the United Kingdom is a different relationship with the European Union, this government has rejected, because we want to ensure that we leave the European Union as one united kingdom.
It comes after Mrs May dismissed the EU's proposed backstop as unacceptable, setting out options for Britain to choose from: an extension to the transition period or a temporary UK-EU customs territory, which was first outlined earlier this year.
Because without a backstop in the withdrawal agreement, there'll be no withdrawal agreement. Without the withdrawal agreement, there'll be no future relationship. Nothing is agreed until everything is agreed. So it doesn't matter what future relationship you want. We do actually need to deal with this backstop issue.
Well, now, Mrs May also said the government doesn't support a second referendum after, have a look at this, thousands marched through London on Saturday demanding a public vote on the terms of Brexit. Well, for some of you who've been watching Ticky for a while, you'll understand that I've been getting withdrawal symptoms as a result of not having spoken with David Buik for several months on air. Well, the great news is he's back and standing by. I'm delighted to say David Buik joins me live from London. David, great to see you there so early in the morning.
Ticky, bless your heart. So glad to be back to talk to you.
Right. Well, now this giant subject of Brexit. We've got the Prime Minister heading for what the 1922 committee, which is the Tory backbencher or the government backbenchers, and I think one of them said she ought to take a noose with her.
Well, I'm sorry, but that's absolutely disgraceful comment. It's not worthy of a member of Parliament or anybody involved in any kind of international politics. And I do wish they'd cut it out. Unfortunately, we've got into a situation where the temperature's been raised on both sides of the channel, and it's extremely unhelpful. It's very unconstructive. Yesterday there was rumours in the press that the UK government were going to withdraw their divorce settlement of £39 billion in the event of a no deal. That, if it's true, shouldn't have come out. Then President Macron responded by saying we're going to shut Calais, which would absolutely freeze northern France, as well as the United Kingdom. These comments are very unhelpful. The problem, Ticky, really basically comes back to about three things. If I've just got a time, if you could just indulge me. First and foremost, when the referendum was called on the 23rd of June, David Cameron didn't think this out. When you're having such a momentous decision, which is going to change people's lives irrevocably for a huge period of time, to just have an in-out vote where one majority of one could win it is insane, madness. It should have been a majority of 60. And everybody can see the consensus of that, because you talked very eloquently a few minutes ago about, you know, a second referendum and how 600 and 700,000 people had a lovely day in the sunshine last Sunday. That's not constructive, because that would make the country even more divided. And it's a very unsatisfactory situation. Then we had a ridiculous general election on the 1st of June when the manifesto was so bad, the Prime Minister gave herself no majority, which leaves her in an incredibly weak position. And unfortunately, the divisions within the Conservative Party and all over the country are widening and are hardening and are becoming increasingly unpleasant. She's dug herself a hole. She's got two very good advisors in Sir Tim Barrow and also Ollie Robbins, who are getting a lot of stick in the press, undeserved in my opinion, because civil servants take instructions. And I get the impression that Theresa May is absolutely determined that Chequers is the only possibility of getting a deal done. Personally speaking, I think she's wrong.
Okay, right. Well, meanwhile, of course, Europe and various people in Europe, including Emmanuel Macron, are doing their best to stir the possum. And we all knew that they were going to make the most out of the Irish border situation. I mean, how do you see the Europeans, MO, at the moment?
Well, the Europeans are in a uniquely comfortable position, with arms folded, good body language, lots of smiles, because the UK called the shots and said, we want out of here, much to the chagrin and disappointment of the European Union. I mean, I make no apology, I am a Brexiteer, but I don't believe in bad behaviour, I don't believe in angst and unpleasantness and anger. And unfortunately, because of the narrowness of the majority and the fact that the Prime Minister has no majority, she's caught between a rock and a hard place, because she needs the DUP's 20 votes in the House of Commons to maintain a majority. And Ireland has become the catalyst, which is ridiculous, because not that I want to see the United Kingdom broken up, but I simply cannot believe through technology, where there's a will, there's a way. If people want to include Ireland in all negotiations, Northern Ireland that is, in all negotiations, it should be a relatively simple task. And I can't blame the European Union for making it a very difficult one and an impossible one. Now, if that's the case, Theresa May's Chequers deal, which means, you know, that Ireland cannot have the borders that it wants, means no single market and all the other things that go with it, you've got to go back to the drawing board and find something that does work. Time is running out, and now we've got everything at fever pitch, and it's become very unconstructive.
Okay, so does that boil down to, I mean, we've also had on the European side, you know, Emmanuel Macron calling Brexiteers liars, and, you know, it's the rhetoric has sort of gone up as well on that side. Is it time for somebody other than Theresa May to do something about this, or is it all just too late?
It's too late. First and foremost, as I say, I'm no luminary on the subject, but I'd be very surprised that if Theresa May is Prime Minister of this country after March 2019, I think the whole of the Conservative Party needs to get behind her to get a deal done. Unfortunately, any deal that is done, whether it's a Canada Plus, whether it's a Norwegian, whether it's a Chequers one, which she's determined to have, will not satisfy anybody at all in the United Kingdom, because it'll be completely watered down. And we'll all, you and I have a conversation in a year's time, and I'll scratch the back of my head, and I'll say to you, Ticky, what the hell was that all about? Because nobody is going to be better off as a result of it. So those people who really want to drive a wedge through, I mean, they're being very silly, because in the wings, which is worrying business far more than Brexit is, I can assure you, I've been to a number of lunches and meetings and campaigns during the course of the last 3 or 4 weeks. People frankly, they're not that concerned about Brexit. They're much more concerned about Mr. Jeremy Corbyn. And business, industry and commerce know that that could be a real problem for them. And therefore, they would prefer to get behind Mrs. May to try and persuade her that her Chequers deal is the wrong one, and that if she were to take counsel from other people, including Ollie Robbins and Sir Tim Barry, who I think have probably got a couple of Gioconda smiles, they won't say anything because they can't realise, I think, that Norway or Canada Plus is the only way forward.
Ah, right, OK. And so as far as this 1922 committee is concerned, and of course this was the committee that got rid of Lloyd George, wasn't it, back in 1922, they're not going to... Yeah, they're not going to do, there's going to be no vote of no confidence or anything like that, because that could flip it towards Jeremy Corbyn, of course, couldn't it?
But it would do. It would do. I mean, apparently there's a lot of threats around that they've already got 48 of the 50 Conservative MPs they need to call a vote of no confidence. But I think when a push comes to a shove, the ramifications of actually doing that are so dangerous for the country if you are a business supporter. And therefore, you know, basically, I think they will try and get behind the Prime Minister and try and persuade her that the way she's trying to get this deal done, with time running out, is probably not the right way of doing it. It's all very well people who are very strong Brexiteers, of which I'm not, saying gung-ho, fix Bennett, and over the top, to hell with it, we want no deal, we'll do a WTO agreement with each country. That would lead, in my opinion, to absolute havoc, and I would be profoundly against it, as I think most moderately sensible people. I mean, in fairness to the Brexiteers, what they're seeing, which is what they don't like, is the European Union growing in federalism by the day. And this is not what people who believe profoundly in the sovereignty of their country and deciding their own laws want. The other thing is that the European Union, like it or not, we do 40% of our trade with it. Its growth in Europe is the lowest of any of the continents. And we should be, as your very charming Canadian guest said before me, we should be engaging with China, we should be engaging with Africa, with South America, and all these places which have got huge business to do, and we should all be doing that on a bilateral basis.
Briefly, I must get your view on Italy at the moment, David.
I'm loving it. Well, I would do, wouldn't I, as a Brexiteer. This is a repeat of Greece all over again, isn't it? Is that the Italians have got themselves in a bind. We've seen their 10-year bond yield go up in a year from about 1.7 to 3.60. They put forward a preposterous budget, which they know that the European Union will never agree to so long as night follows day. But they are absolutely determined to try and get themselves out of the bind that they've got themselves in. And I think you'll probably find that there'll be a lot of huffing and puffing. And I think that the Italian stock market will probably decrease a bit more and the bond yields will go up, and eventually in the end I think the European Union and the IMF will beat Italy into submission. And I hope very much that they have a referendum and decide that it would be in their best interests, and with great charm and candidacy, which you would expect with the Italian people, that they will say au revoir or sayonara or whatever you do.
All right, David Buik, it is great to have you on the show again. Look forward to chatting to you soon. Thanks very much, sir. Bless you,
Ticky. Thanks so much.
All right. The US president will meet with his Russian counterpart in Paris next month. The last time the pair met, Donald Trump was accused of being too friendly. But since then, the mood has become much less warm, with Vladimir Putin warning of unprovoked moves from the US over their nuclear treaty.
These talks were never going to be easy.
Frankly speaking, it's sometimes surprising for us to see the United States taking unprovoked steps against Russia, which we can't call friendly. Basically, we don't even respond to any of your steps, but it still goes on and on.
Front and centre, President Trump's announcement he'd pull out of the INF Treaty, one of the last remaining pillars of arms control between the two former superpowers, because, he said, of Russian violations, which Russia has consistently denied.
It is the American position that Russia's in violation. It is Russia's position that they're not in violation. So one has to ask, how do you convince the Russians to come back into compliance with obligations they don't think they're violating?
Under the Intermediate Range Nuclear Forces Treaty, medium-range missiles were banned. In the 1990s, nearly 2,700 missiles were destroyed as a result, more than half of them in the former USSR. But despite the danger to the missile agreement, what's not in doubt is that the number of nuclear warheads is far lower today. At the end of the Cold War, Russia had around 30,000 warheads, while the US had 21,000. Fast forward nearly 3 decades and Russia's stockpile has dropped to 4,350, with the US stockpile at around 4,000. The Chinese, not party to any agreements at the end of the Cold War, now have around 280 nuclear warheads. Now, if President Trump's word is anything to go by, the INF is a dead deal and a fully fledged nuclear arms race could be back on.
They have not adhered to the spirit of that agreement or to the agreement itself.
The concern in Europe that starting afresh on arms control when US-Russian relations are this bad will lead nowhere, leaving Europe, not the US, most at risk from missiles Russia will have free rein to develop. Diana Magnay, Sky News, Moscow.
After the break, we're coming back home. Australia going from first to third as the preferred global destination for infrastructure investment. We'll find out why with IPA's Adrian Dwyer next.
Now, back to Ticky.
Welcome back. Now to a pretty interesting report. New report revealing that Australia's reputation for infrastructure investment is actually under threat. The report finds that Australia has gone from first to third as the preferred global destination for investment, with a vast majority of those surveyed saying uncertainty around government policy and regulation puts them off. Well, what a surprise. For more of this, let's bring in IPA CEO Adrian Dwyer. Adrian, well, look, here's your report. Excellent report. I mean, the sort of people that you've interviewed for or surveyed for the report, how much money do they represent?
So we interviewed 33 investors with $380 billion worth of infrastructure
$380 billion dollars of global funds available for infrastructure.
Just in infrastructure, already invested with more to come.
Right, okay. So we're talking, massive funds, sovereign funds, presumably multinationals.
Yeah, so things like superannuation funds here in Australia, Canadian superannuation funds, sovereign wealth funds. So these are people with big allocations of money to put into our infrastructure or elsewhere.
And they don't have to put it here.
No, they don't. So capital's highly mobile. It can go anywhere in the world. It can go into infrastructure. It can go into something else. So this is a race we have to keep up in, which is why some of the things in this report should be a bit of a canary in the coal mine for government.
Well, you've called it exactly that. This should be the canary in the coal mine. Now, what are the big concerns? What are your main findings?
So the biggest area of concern amongst investors this year is energy policy certainty. So 90% of the investors we surveyed said Australia is an attractive market. They're likely to invest in Australia, but nearly as many said the energy sector is full of uncertainty in Australia, and that's off the back of repeated reviews, the National Energy Guarantee and everything that happened with that.
And when you think about investment in infrastructure that is supposed to drive economies, you're going to use energy to build the infrastructure, and then your economy is going to be driven by what the electricity prices are.
Energy is an input to everything, and there's $1 billion worth of investment just to maintain the networks we have in energy. So real investors with real dollars making real decisions saying, actually, this is spooking us, what's happening with the energy market. It should be ringing alarm bells, and I think this report shows that.
So we went from 1 to 3 as preferred global destination. Who's jumped ahead of us?
So we've seen the US, North America and Europe really increase. Now, the
All
US,
of them? What, the whole?
Well, yeah, so it's North America and Europe. The US has reduced the headline corporate tax rate, so that clearly
and energy's
some interest. Energy's cheaper. In Europe, it's really an ageing infrastructure story where lots of networks are coming to the end of life, so investors are saying, actually, we'll allocate some resources there because there's lots that needs to be rebuilt.
Right, OK. Any good news at all?
So there is good news almost across the board that 90% of these investors are saying, yes, they want to invest in Australia. Social infrastructure, really interestingly, has gone up 30 percentage points since the last time we did this survey a year ago. So keen interest there. Roads, tunnels, bridges, that kind of investment is of keen interest for these guys. So there's lots to be
And the concern, you say, is intervention, say, in energy. Is it actually a broader concern about how comfortable the government has become intervening in anywhere where they feel, well, seem to feel that the public have a bit of an issue?
So the message we're getting from investors quite clearly is that the reputation is hard won but easily lost, and it doesn't just affect energy. That's the key thing from this, is that it can be in one area, it can be energy, it can be the ACCC, it can be
hello, a bank levy.
They can be real issues for investors because they look across the board. They have to take these to investment committees in overseas HQs, and you get questions about all of these different things that have a cumulative impact over time.
And we haven't seen that so far, I don't think, in Australia impact. I mean, there's the odd decision for Incitec Pivot several years ago to go and build their factory in America and not here. But it's quite hard to see that if you're looking at the decisions that are being made at a multinational level or at a sovereign fund level, because you don't know what you're going to miss out on, do you?
Well, they say, the investors are saying to us that Australia's a great place to invest because there's a long track record of doing things well, but when you get something that impacts that image, that hurts that reputation, things like a project cancellation or government saying that, or regulators saying at the last minute, no, we're going to delay a process, that has an impact.
How are we going to know and measure what we lose out on?
Well, look, these guys manage $380 billion worth of infrastructure assets globally. So if this group of people sneeze, we catch a cold. So but
are they going to come out and say, actually, we have now put, $20 billion in America. We could have put it in Australia. We were going to, but no, we decided not to because of this.
I don't think we wait for that. We heed the warnings in this report. We make sure we're not intervening in markets, and where we treat these investors fairly and reasonably, we can expect that to flow on to consumer bills in things like energy. Got to heed the warnings.
Right. Very interesting report, Adrian Dwyer. Thank you very much for coming in, talking to us about it. OK, and that's all for the show tonight. Tomorrow night, Fortescue Metals CEO Elizabeth Gaines. Until then, thanks for your company.